Okay, this is gold denominated in dollars. All that we saw in the past is rupee. Like when you and me buy gold. This is gold in the international markets. And here it becomes pretty clear what gold's done over the last 35 years. Late 60s, I think 1969 or 1970, the Bretton Woods Agreement came to an end, and the price of gold effectively became decontrolled all over the world, and that's why you had this sharp rally and you had this Gulf crisis and all that. 71. That's the year. And after that, of course, you had this Gulf War, the oil embargoes and all that. But having said that, if you had held gold somewhere around here, that's 1978 or 79, and you had held it till date, that's 30 years, in dollars, you would be even. On an inflation adjusted basis, you probably lost all your wealth. So long term is damn good. The last 8 years are very good for gold. But what one needs to realize that in the larger context, over long periods of time, gold is not really all that much of a wealth creator. But this is the dollar market. We need to look at gold denominated in rupees because rupee also loses value over time. And therefore, this graph is more relevant. This is of course a more steady line going up. Reason is because as rupee loses value, gold will become more valuable. So you know that it adds to your overall returns. And this is a pretty much straight line. Only thing you need to note over here is that again over this 35-year period, a lot of your returns have come up here in this large chunk. So if you were invested in gold in dollars, you earned 7% per annum compounded over 34-35 years. If you were invested in rupees, 12.5 years. That basically tells you that about 5.5% per year is the depreciation in the value of the rupee.
The gold deposit certificate scheme announced by the government of India in 1999 used to offer between 3% to 4% tax-free interest annualized, as also exemption from wealth tax. What is the status of the scheme as on date?
Frankly, we spoke to some banks. Apparently, there's nothing happening on this scheme. The SBI person did tell us they're working on something. So I'm not sure whether for practical purposes this scheme still exists. In fact, it's been pulled out of the websites of the bank. So having said that, I would like to spend a minute on, I missed it. It exists. It's not being said is of course has wealth tax benefits. It doesn't count towards your wealth tax. And gold in physical form long term is 36 months. Gold via mutual fund long term is only 12 months. But we have an issue with gold ETFs. And that's primarily two. One is that when you are buying a gold ETF at the NFO stage, you will pay an entry load of 2-2.5%. Yeah, and that money goes to your distributor. How many of you have read any of the gold ETF research notes on personal FM? Anyone's read? Yeah, so that's why we've been telling our clients not to invest at the NFO stage. You can buy the same gold ETF once it's listed on the NSE or the BSE and just pay your broker that 0.5%. So you'll save 2% of your money there. Secondly, when you invest in a gold ETF, be very careful what are the annual maintenance, management fees. We tried to, couple of funds which are launched, they were not very clear what their fees is. They said they'd be in line with SEBI guidelines, and they said they would aspire to limit the annual expenses to 1%. So, I'd like to believe them, but history doesn't suggest that, everyone will stick to his word. So be careful when you commit money, understand what the limit is on the expenses. Having said that, I think if you already have a sunk cost in terms of a bank locker, for example, I think you should also buy physical gold.